right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. I'm dummy number one, Kyle Demian. I'm joined with dummy number two, Renji Matthew, here today. And on today's podcast, we're going to be talking about how the wealthy use and leverage life insurance. And we've talked about the topic before in previous episodes. This time, we're actually going to be diving into some numbers and showing how the wealthy can actually take money out of their life insurance and use it for acquiring assets and building their passive income and building their net worth, essentially. And we're going to talk about how there's three different ways to take money out of life insurance. We're going to talk about the pros and cons to each. And then we're actually going to dive into a real case that we have. Just came up on an annual review for one of our clients that is putting $40,000 a year into their IUL policy. Now, you might be thinking, why in the world is somebody putting $40,000 a year into life insurance? And we're going to show you exactly why, because of all the benefits that come along with it, right? So with that, Renji, let's get started by talking about, and I'll share my screen here in a few minutes, and we'll actually show and dive into the numbers, but there are three ways to take money out of insurance. I like to say there's the good way, there's a better way, and then there's the best way. Can you take us through the good way of taking money out of life insurance, or all three if you want to?
The worst way is to just withdraw the money, right? The problem with withdrawing the money is the reason you are putting it inside of life insurance is so that you have the tax-free benefits, right? Under the umbrella of insurance, it's growing tax-free. Like we've mentioned before, other than Roth IRAs, the only other vehicle where you can grow your money and keep it protected from the IRS taxing it is inside of life insurance. So if you withdraw the money, now it's not inside the policy anymore. So it's going to, if it's already tax money, then you don't have to worry about it. But any growth that comes with it, you're going to pay tax on. Because it's not protected under the umbrella anymore. So that's the worst way to take the money out. Another way is to borrow the money. And then there's a couple of different ways you can borrow it. If you borrow the money, loans are never taxed. And this is true with any type of loan you take. You never have to worry about paying tax on the loan. Kyle, do you want to go into the two different ways of borrowing?
Yeah. So the first way is what they call a wash loan, where the insurance company will charge you a 2% rate to borrow the money. And then at the end of the year, they're going to credit you back 2%. So it just washes out and there's no net cost to you. And there's also no net cost to the insurance company. It just breaks even, right? And when the best way to borrow money out is what's called an index loan. And an index loan, what that is it allows you to borrow the money. And here's another key thing. Some insurance policies have a maximum rate that they'll ever charge you. So this is one thing you should ever look at, or you should always look at when you're going to set up your IUL is what is the maximum rate they could ever charge me when I go to borrow money out of my IUL? And we like to use companies that will only ever charge maybe a 5 or 6% interest rate, which is really good in the current interest rate environment that we're in, because most loans right now are going for 7, 8, 9, or maybe even 10% being the average, depending on what type of loan it is, of course, right? So right now interest rates are high, but some of these IUL companies have caps or maximum amounts that they'll ever charge you for when you borrow your money. So if you have a company that charges you a maximum 5% rate of interest to borrow money from your own account, what's awesome about it is when you borrow and when you take out that money, your account value is still going to show as if you never touched that money, you never pulled it out. What that means is you're still going to be eligible for interest and growth that year. So if the market goes up 9% and you get a 9% growth inside of your IUL, they're going to subtract that 5% rate that they would have charged you, and you're going to get a 4% gain on the money that you borrowed, right? So people, real estate investors, other entrepreneurs that we talk about setting up these IULs for, when they borrow and take out this money, they go and put it inside of real estate, right? And maybe their money is making 20 to 25% of profit or ROI inside of their real estate, right? And what's better than 20 to 25% rates of returns? 28, 29, 30%, because now their same dollar bill is working in these two locations. right? So this is how the wealthy leverage and use their money to make money in multiple areas. And as we talked about before, there's also many other benefits to using IULs in life insurance. The money's tax free, not exposed to market risk. God forbid if they were to ever pass away, there's still a death benefit attached, right? So that's going to pay out to their family. And then the last benefit too, especially for, high level entrepreneurs, money inside of life insurance is not in most states. You can't ever be sued and can never take the money out of life insurance, because at the end of the day, life insurance is to protect your family, and these courts and these lawyers can't take money away from your family that's protected inside of life insurance, right? So this life insurance umbrella, that once you have your money inside of it, just gives you so much extra protection, and it gives you a lot more flexibility too, right? Because if you were to put this money inside of a 401k or an IRA, those are what are classified as retirement accounts. So if you ever go to try to pull your money out of those before the age of 59 and a half, in almost every single scenario, there's going to be a 10% penalty, plus potentially taxes coming out of it too, depending on whether it's a Roth account or if it's a traditional IRA or a regular 401k, right? So these entrepreneurs and investors, they just don't really have any other place to store their money where it gives them tax-free benefits, no market risk, and most importantly, where they can use it under the age of 59 and a half. So with that, Renji, is there anything else you want to add, or should I share my screen and we kind of go into and show the numbers that's based on, one of our clients we actually have, and kind of break
Yeah,
down the numbers and the math together?
I think we should just go ahead and show the numbers. Again, I want to clarify for everyone that's watching. This is just one example, just because Kyle just had a review with him. This happens with a lot of clients, and we'll just break down the numbers. That way it makes more sense. Show you guys what the account looks like, where you borrow from, what that does to the insurance policy, different things like that. Go ahead, Kyle.
Perfect. And then, so this is for a client. His name is not John Doe. I just switched it to John Doe, obviously to protect his identity, right? But he is 30 and he is a non-tobacco user. And as you can see here, he is contributing $40,000 a year. So when you put $40,000 a year into an IUL, this is what this may look like. Like there's a lot of numbers on this screen, and we'll take you through them here in a second. But this is the projections of what this account could do, right? And the column that we're going to look at over here is going to be estimating about a 6.91% rate of return. Now, that's not my number. That comes from the insurance company, and this is the amount that they allow us to show on these projections or illustrations, which is what the official name of this is. And as you can see over here, this shows his age. The year column shows how many years into the policy he is. And then planned premium outlay shows how much he's contributing on an annual basis. So this gentleman, John, Mr. Doe, is doing $40,000 every single year into a IUL that is properly structured and completely maximum funded. What I mean by that is he has the least amount of life insurance that's required for him to contribute the maximum amount of $40,000 a year. Okay. So when we do this, we are purposely lowering the amount of insurance so that we lower his costs and his fees inside of his insurance, right? Because we're not putting the money inside of the IUL for the life insurance and death benefit. We're utilizing the rules and laws of insurance and the benefits that come with using a properly structured IUL, as you'll be able to see here. So there's these two columns. One labels account value, one labels your surrender value. Your account value is like what your true cash value is at any given time. And then your surrender value is just what you can access in any given year, right? So as he starts contributing the $40,000 a year, we just completed 1 year for him. And he's got access to $26,000 if you wanted to borrow this year for real estate or any other, reasons or potential purchases. And this gentleman is an entrepreneur. He is an investor. And when we set this up, the money going into here was more so like a 2 to 4 year plan. He was looking at, in 2 to 4 years, potentially borrowing anywhere from 60 to upwards of 140,000 to allow him to use that money to go out and buy real estate, right? If you're an investor going out and buying real estate, typically they require anywhere from about 20% down to maybe a little bit more. So in year 2, if he was to be able to borrow, about $60,000 out, 20% down would allow him to be able to go out and acquire a $300,000 property. Maybe that's a single family home, maybe that's a duplex, or maybe that's a quadplex, right? But this gives him the flexibility to use and access this money to become his own bank, borrow from himself, go and take the money out of the IUL, put it into real estate, right? And like we said, when you borrow it the smartest way out of the IUL, he can have that same $60,000 now working in two locations. One location still inside of the IUL, the other location being inside of real estate, right? And the cool thing is when you do real estate and you have cash flow, guess what he plans to do with that extra cash flow? He's going to take that extra cash flow and put it right back into his IUL. And it becomes like this, I don't know, waterfall
Cycle.
or cycle. Yeah, I like that. It becomes this cycle where he's making money, putting it back into his IUL to stack up and save more cash so that, in another 1 to 2 years, guess what? He can go out and acquire another property, another real estate property, right? So Renji, did I miss anything, or what else do you want to add to this?
So you talked about what the numbers would look like if you take money out of the surrender value, right?
Yep.
Okay, so one of the things I could think of, which I get asked all the time, is like, okay, so if they put in this much, why can they only access this much? So if you if you guys look at the screen, you see it. If you've ever looked at a mortgage amortization before, if you have a mortgage, you know what that is, and you'll know in that first 5 years or so, depending on the bank you have it with, most of the time it's first 5 years, sometimes it's first 10 years. Everything you put in, more of your money that you put in for the mortgage payment goes to your interest than the principal. But then after those 5 years, as time goes on, more and more of your money is going to the principal, right? It's the same way in this illustration you see. That's why that first year it's a bigger difference. But as the years go on, they get closer and closer together, right? So it's the same scenario. What you want to be careful for when you have someone set this up for you, you have to make sure that the surrender value does not show zero in that first couple years. If it shows zero, that means they set it up where it's not benefiting you. It's benefiting them in their pockets more so, because you want the lowest amount of death benefit with the highest cash value growth. You're not doing this for life insurance. If you're doing it for the higher death benefit, you don't need an IUL. You're doing the IUL for the cash value growth. So if you're doing it for the cash value growth, you want the death benefit to be as low as it can be, so the cost is as low as it can be, and most of your money is going to the growth side. So in this scenario, that's what you're seeing. They're setting it up for buying assets. So worst case scenario, let's say John never goes and buys an asset and he just keeps putting that money into this, right? Eventually, when he's 65, can you scroll down, Kyle? Does it show to
Yep.
65? Okay. At 65, he's got 4.7 million. And that's at a conservative rate of growing at 6.9, because we've talked about this before. In a 10-year period, the market does on average on a bad year, 10-year time, it's 8%. And it could be anywhere 8 to 10% on average. So 6.9% is conservative. So even at a conservative rate, by 65, if he never uses the money, he would have 4.7 million in there. And at that point, he can start taking out 390,000 every year tax-free income. And that's just from the IUL. That's not counting anything else he's doing outside of this. So like Kyle said before, if you're using it to buy passive income, the best way to do it is borrow and then put it back into it, with just like you would pay a mortgage. Whenever you have a renter in there, whatever rent you're getting from that house, you're paying the mortgage off. Just the same way, you pay this down and then you do it until you replenish, or you don't have to wait till you replenish it, but you can, and then repeat that cycle until you buy enough assets where, again, we've talked about what is financial freedom. Passive income over expenses. You're financially free. Now you repeat that cycle again and again until you build enough wealth to where you're happy, right? So You could do that same exact thing with this. And again, this is the right way to set it up. There's a we're just covered the basics of this. There's a lot more stuff in depth we can go into, but uh, I don't think we want to do that on this episode because it's going to be 2 hours long. That's where you want to do a one-on-one because again, these don't. It's not a one size fits all. Everyone's numbers are different. You might not be able to do 40,000 a year, or you might be on the other side where you could do 200,000 a year, right? So it's not one size fits all. This is why we want to do one-on-one calls with people to see what scenario it might fit for. Again, this might not be for everyone either.
For sure.
It, so yeah, that's all I wanted to add, Kyle. Is there anything you want to
Cool.
go off of that?
Yeah, just a couple other things too. Because people that might be watching this, whether it's other advisors, other people in the industry, and or other people maybe that have heard that, using whole life instead of IUL. Of course, it's always a case by case basis. And this particular client liked the IUL better after looking at the two side by side because of this basically plan B to fall back on. He said his goal is to get into real estate within the next 2 to 4 years. If it never happens, he really liked just the cash accumulation and the possibility of having, 4.7 million at 65, and that allowing him to have $390,000 a year in income. He really, really liked that. So, IUL versus whole life, there's a lot of debate going on. We're not necessarily saying that IUL is better, but for our clients, we show them both, right? We educate them on the pros and cons in both. One of the pros and the benefits to IUL over whole life is that you do have the potential for larger rates of returns because it's based on an index. That's what the I stands for in IUL, Index Universal Life. So you get the growth of a selected stock market index. This one happens to be based on the S&P 500, which is index fund in the United States that tracks the top 503 companies in the United States. So with that, as we kind of round up, I did get a question in the chat, a couple questions actually that are good. One being, why has my financial advisor never told me about this? And Renji, do you want to answer that, or you want me to? Because we might have the same answer, but we both might have different answers.
I think it's similar. Yeah. So financial advisors, there are financial advisors that we know personally that do use this strategy, but most of them don't because we've talked about how financial advisors make their income, right? A lot of times, I think we've talked about, and we'll just recap real quick. So there's two ways that most financial advisors make money. One is assets under management. So the amount they're managing for you, they make a percentage off of it, and the percentage can vary depending on the brokers they're working with. And then there's financial advisors that just make a fixed amount upfront for setting you up, and then they don't make money off of you again. So with traditional financial planning, they're doing assets under management. So they're making income off of you every year, no matter what the market does. Even if you're going up or losing money, they're making money off of you. With IULs and stuff, if it's set up the right way, they don't make us that much money up front. If it's set up the wrong way, they make plenty of money. But if it's set up the right way, where you have cash value to do what we talk about, buying passive income assets, then the commission is not that high. And it's just a one-time thing up front, and you don't get paid anymore. So a lot of times why financial advisors don't recommend these is because they don't benefit from them long term like they do with 401ks or IRAs and stuff. So that's my short answer. I guess it wasn't that short. What about you, Kyle? What would you say?
Yeah, so for most financial advisors, they typically just only offer what their firm tells them that they can offer. Whether you're don't want to say any specific company names, but typically financial advisors can only offer what their firm does, which most firms are, just mutual funds and or, just stocks, things in the market. The IUL is a different strategy. In the past was reserved just for the rich and the wealthy families inside of the United States because they had advisors that would educate them and tell them about these type of things, right? What started to happen over the last, really 10 years is social media and different ways to, spread education about these different types of wealth building avenues that are out there. And it's not that these accounts just only make sense for the rich and the wealthy, um, but they do make sense for the average middle class American. But it's not often that financial advisors are calling up middle income families trying to help them with their retirement savings and stuff, right? Over the last 5-10 years, lead generations become um, much more diverse, I guess, with internet, social media. And so there's people like us and others that just post educational content online to share with everybody what's out there and what's available. And the new way of marketing is to let them come to you, let them show interest by filling out a form, requesting more information, messaging us, and scheduling a time to chat just to see if it's right. 10, 20 plus years ago, the internet wasn't around, right? So financial advisors would in wealth planners like this would just call on people that had millions of dollars of net worth, because that was the only way to spread this education, and they had extra money, right? That they knew that they could for sure, basically help them set these kind of accounts up. So with that, that was a great question. Why why your financial advisors never told you about this? And then we did get another question from Zane, and I think we have a call in 10 minutes. Yes, we do, Zane. I was just looking at that. Yeah, we'll be wrapping up here in about 5-10 minutes, and I'll give you a call. And Zane had asked a question about where did it go? He said, "Can you put? Oh yeah, can you put a large amount of money at once into an IUL, like a million, for an example?" So inside of an IUL, it wouldn't make sense. You would want to break it up over either probably 4 to 7 years. We'd have to look at the numbers to see what makes the most sense. Unless you're planning to put $1 million every single year into an IUL, then it would be okay. But typically, what you want to do, and here's why: if you put all $1 million into year one, it's going to spike up the insurance amount, right? And when you have more insurance, that comes with more cost of insurance, the more fees, right? So your money's not growing as efficiently as it should. If you spread out that money over time, for example, maybe we looked at $250,000 a year for 4 years, because you're not putting $1 million all up front, you're going to lower your amount of insurance. $1 million to $250,000 in the first year is going to have a lower amount of insurance because you're not putting in as much, right? Which lowers the fees, lowers the costs. And then you would fund it over maybe 4 years. We'd have to look at the numbers to see what makes the most sense. But typically, for funding of an IUL, you at least want to contribute the same amount for maybe at least 4 to 5 years, as long as it's a substantial amount. Otherwise, we have clients that are contributing, the same amount for 20, 30, 40 years. That way, just the consistent compound interest over time really grows and accumulates your IUL and your cash value. So that's a good question, Zane. Hopefully that answered it. Let us know if you have any other questions about that, Zane.
To go
Renji,
along with
anything else you
that,
want to add?
yeah, so the IRS rule, guys, is that you have to have a certain amount of death benefit to be able to stash a certain amount of money. And this is going along with what Kyle said before. If you put in $1 million in, your death benefit has to be high enough, and that could vary depending on age and health and stuff like that. But your death benefit, let's say for this example, if you're putting in a million, let's say your death benefit has to be 10 million, right? But if you're putting in 250,000, your death benefit probably only has to be a million. But the higher your death benefit, your cost is higher too. So that's what Kyle was saying. If you put a lump sum in at first, your cost of insurance is going to be so high because your insurance death benefit has to be high enough to be able to allow the rule of being tax free inside an insurance policy. And with this scenario, you can do that. It's not that you can't, but keep in mind that's actually benefiting the insurance agent more than it's benefiting you, because their commission is going to be high because you did a high death benefit. And so the cost is high. But if you break it down over time, your death benefit is low because that's what we want. We want your death benefit as low as it can be so that you can stash money in and let it grow tax free, and your costs can be low. And another thing to think about, these companies credit you at a point-to-point system. What that means is, let's say today is April 19th of 2024. If you put in $1 million today, the company looks at what the market did since April 19th of this year to April 19th of 2025. And if the market did 10%, in that time, you get that growth in the end of the year. If the market did zero or negative, nothing happened because you don't lose any money. Now imagine if you broke that up into let's say you did 100,000 each year for 10 months, or each month for 10 years. I mean, for a year, sorry. So that's 100,000 now, and then in May of 19th of 2024, you're putting another 100,000. Now that first 100,000 in that same scenario I used earlier of market growing 10%, if the market didn't grow at all till, let's say, the market went up 10% April 21st of 2025, right? So that's just past that first year mark. If you did that, that first 100,000 didn't grow that 10%, but that second 100,000 you put in got the 10% growth because they're doing point to point. So it doesn't grow like it does in the market. So meaning like it doesn't go up and down every time the market does. It's index. So they wait till the end of the year to see what the market did, and they credit you at the end. So if you split it up, I say all that to say, if you split that money up, you're growing. The growth does a lot better. And this is where Kyle was saying we got to look at the numbers to see if it benefits you more if you split it up over 4 years, 5 years, 7 years, whatever it is. We would play with those numbers to see what gives you the best growth over time. And that's what, yeah. So it's better to split that money up. Hopefully that answered people's questions.
Yeah, that's good. And there's no further questions here in the chat either. So I think with that, that's a good way to wrap up and wind up the show. This, just to quickly summarize, we talked about why the wealthy, put thousands, sometimes hundreds of $1,000s a year into accounts like this, right? And it usually comes down to three different things: the tax advantages, the fact that there's no market risk, don't have to worry about the market crashing and ruining their savings, right? And the last one being the accessibility, the ability to become your own bank and be able to borrow from yourself instead of having to go and borrow from a bank, prove your credit, have some large interest rate, have to get approved for it, prove all this with all this documentation, right? This is just much, much simpler, and it protects your money in a lot of other ways too. So with that, if this sounds like something you guys may want to look into and potentially see if this is a right fit for you, or maybe other wealth building solutions would be right, feel free to reach out. That's what we're here to do, is to help you out. And with that, make sure to like and subscribe and drop your comments below. Let us know what questions you have. If you guys want us to do more content kind of breaking down the IUL and whole life policies, how they work, why they work, and maybe some other case scenarios, case reviews that we can do like this, let us know. Maybe that'll be a good future show that we can show you guys to just provide more value. And with that, thank you guys for watching, and we'll see you on the next episode. Take care.